Hey folks, welcome to episode 1 of the Housing News Special Edition Mortgage Masterclass. Our first expert in this 4-part series is Dr. Orphe Divounguy, senior economist of Zillow Home Loans. As a senior economist at Zillow Home Loans, Orphe is a member of Zillow's economic research team. In the past, his work has focused on housing and labor markets, as well as quantitative methods for policy evaluation. Orphe earned a doctorate in economics from England's University of Southampton, where his research focused on highlighting the importance of trading delays for market participant decisions and ultimately market prices. Orphe is also a board member at Housing Connector, a nonprofit dedicated to lowering barriers to housing. Orphe, welcome to this special edition of Housing News.
Oh, thanks for having me.
Orphe, we're going to keep this conversation really focused, but also keep it natural. So if we hit on some themes that you're excited about, feel free to help guide us in the right direction. But the main theme we're going to talk about today is how market participants are navigating volatile mortgage rates in a changing housing market. So Orphe, if I can kick you off, what dynamics are buyers and sellers currently facing in this market that we're navigating in 2023?
Yes, when we look at our March data and we saw the typical home value climbed up roughly 1% from February to March, the strongest growth since last June. But it's no surprise that newly pending listings, right, are down 24% when compared to a year ago. And that really means that home buying demand has kind of fallen from last year. Long gone is the hot, feverish pandemic housing market. But with the spring, the demand rebounded somewhat, right? So, we know people buy in the spring. And so you have buyers coming back to the table, kind of braving the large swings, the higher mortgage payments, the large swings in mortgage rates. But, what we're also seeing is sellers not showing up, right? Sellers haven't quite showed up yet to this party, right? The new listings are down 22% when compared to last year. And so high mortgage rates are also affecting sellers. I think that's the part that took everyone by surprise. We all expected that with the typical mortgage payment increasing roughly 26% now when compared to last year, buyers would take a step back. But what we didn't expect was sellers taking such a big step back and not coming back into the market this spring.
Yeah, as we've talked about the supply constrained market, sellers not showing up at the table has been a theme that's been recurring in a lot of our work at HousingWire and your work at Zillow. When you're giving some commentary there, you mentioned active listings and you also talked about pendings. Are pendings your kind of proxy for the demand side of the equation?
No, not really. But remember, sales reflect both supply and demand, right? And so you have to think about, if sellers are not showing up and there's not enough inventory to choose from, enough options, sales are going to go down, right? So sales are not just a proxy for demand; they reflect both supply and demand. Then you take new listings, and new listings tell you that supply has gone down, right? Supply is really a story of new listings is a story of supply, and so you can look at that and kind of back out what demand is doing, given that what supply is already doing, right? And so we know. I put out a piece of research on this back in October. We know we can estimate how much demand has fallen over the past year. And so, we know demand has fallen because mortgage payments, the typical mortgage payment has increased. But buyers are back. Buyers are back strongly. I mean, in half of the country, we're seeing prices increasing pretty rapidly in this environment. But one of the things that I think is really concerning is the fact that inventory remains so low, right? If you look at inventory is so much lower than it was before the pandemic. That return to normal is so slow and sluggish. I think that's the part that's kind of shocking to most people who track this stuff. It's the fact that inventory just hasn't returned and isn't coming back as strongly as we had hoped. So mortgage rates are definitely having a major impact, and where mortgage rates go to next is definitely also going to have an impact.
So, Orphe, you mentioned that the sellers are still on the sidelines, but the buyers are back in market. In a traditional market, your sellers become buyers and vice versa. So, where are the buyers coming from if they are not the traditional seller who's listing their house and upgrading or relocating and coming back to the market in their second or third home?
That's right. Our research shows that there's been a huge increase in the share of first time home buyers,
Yeah.
right? And and this is very interesting, right? As competition, demand fell and competition decreased somewhat. First time home buyers finally had an opportunity to come in. Not competing with the cash offers anymore, right? Had an opportunity to come back in the market. And there's a lot of stuff being done out there on the policy front to try to help first-time home buyers, and I think that's good news. So more must be done. I think they're constrained by. We know the constraint is the supply side. Who could have guessed, right, that supply would still be a constraint in 2023 after a sharp increase in mortgage rates?
How would you categorize the psychology of the first-time home buyer? They're facing the same dynamics of interest rates that are significantly higher than they were 12, 18, 24 months ago. They're also facing a scenario where home prices has held up, and you just shared your March data, and we saw continued home price appreciation into the end of the first quarter of 2023. What's the psychology of the first-time home buyer, and how are they kind of surmounting these hurdles that are high rates and high home prices historically?
Yeah, look, here's what we know. We know research tells us that buyers don't just vanish, right? When housing costs go up, people delay home buying. So what we're probably going to see is the age and income of first-time home buyers increasing. And what we're definitely already seeing is the type of homes that people buy is changing. If you look at the housing market and you compare it by price tiers, you see that competition for relatively more affordable homes, kind of entry level homes, is still pretty strong. In fact, it's the strongest right now. The prices of the least expensive houses rose by 8% over the past year. Mid-level homes appreciated by roughly 3%, and the most expensive homes lost value by roughly 1%. The first time since 2012. And so we are seeing that shift in the compositions of home that sell because mortgage payments have increased so much. And usually, the advice I give to first-time home buyers is, before you go and look at houses, make sure you know what it is that you can afford, right? And the only way to do that is to enlist a mortgage professional first. Finance first is the best advice you can give buyers right now. Get that mortgage professional to look at your finances, to help you improve your credit. They usually have really great tips on how to improve your credit, because a good credit will save you thousands over the life of the loan. And so I tell, hey, finance first. Get to know exactly what it is that you can afford before you go to an agent and say, okay, well, what's available that's within my budget? And so that's kind of the advice I give first-time home buyers.
That's really interesting. Over the last decade, we've seen the amount of time that a homeowner stays in their home elongate pretty significantly. We used to talk about industry averages that were in the 6-year range. And at points during COVID, I heard that average had climbed up north of 10 and 11, 12 years in certain parts of the country. How do you think this dynamic of more first-time home buyers targeting the home they can afford, which is often in that starter home, like lower 1 or 2 quartiles, how do you think that will impact the amount of time that these people stay in their home, the 2023 buyers?
Look, that's a very good point. I think it's really important to focus on the fact that we have a massive shortage in this country, a massive unit deficit in this country, and builders. Whatever we can do to unlock builders is what we should be doing, right? As on the policy front, right, at all levels of government. I think that is the big problem right now. I think buyers are likely going to first-time home buyers are likely going to buy just to get on the housing ladder, and they're going to want to upgrade. As their families grow, they're going to want to upgrade. People move. We know that people move for whatever reason. life happens. The mortgage rate is part of the constraint, unfortunately, but people are going to want to move. And so, having the inventory there is going to be absolutely crucial. And I think that ultimately new construction can play a huge part in this story.
It's really interesting. There's been, I love following loan originator and real estate agent social media accounts. And there's been a couple post categories that have really popped in the last 6 months. One is the home buyer with unrealistic expectations of what they can afford and what they can get in the market today. And the second is I don't know, some people love it, some people hate it, but the marry the house, date the rate theme. And I wonder that these first time home buyers, as they're coming into the home that they can afford today to get on the housing ladder, instead of marrying the house, date the rate, if we do see a rate environment that's different than the one that we are today, would that actually be a market where homeowners choose to upgrade to the house that will fit their family and their changing lifestyle needs as they progress up the housing ladder?
Yeah, I honestly think that the advice I give people is stop trying to time the market.
Absolutely.
A lot of people are, they hear that advice with stock market, the stock market, and I don't think they hear it enough with the housing market. You're not going to be able to predict where mortgage rates are headed. And so, the best advice I give them is, look, if you love a house, go and get the house. You could always refinance later. And that's what most people have done, right? So, the mortgage rates above 7% were the norm, right? And those low mortgage rates that we got in the past couple of years are the exception. And so I expect, here's what I expect. I expect that inflation is going to continue to play a strong role in where mortgage rates are headed, right? So if you really want to understand the dynamics, you have to focus on inflation. So long as inflation remains far above the Fed's 2% target, mortgage rates are going to stay elevated. But that should not stop people from moving. For life continues, right? You move now. If mortgage rates happen to fall later on, you could always refinance. I don't think the focus on the mortgage rate, is necessary. I don't think people should be focused on the mortgage rate to make life decisions. It's part of the budget constraint, but things are happening. I think. Look, the reality is, even if mortgage rates come down, right, with buyers waiting in the wings, prices are likely going to see upward pressure on prices. And so you can never, you're likely not going to see a situation where you'll have both a big decline in mortgage rates and a big decline in house prices, right? The only unfortunate circumstance where we would have both is probably the worst case scenario, which would be a scenario where you have a big economic contraction and people lose their incomes. And even in that situation, you have sellers today that are sitting on record home equity. You're not going to get the foreclosure crisis that you had in 08, 09. And so, so for people to sit there and think, okay, prices are going to come down, I'm going to wait this out. I think that's the worst advice. And you hear that a lot from some of the YouTubers, right? And they're like, hey, not a good time to buy. Price. No, it's just not going to happen. We're not in a situation where we're going to see a big foreclosure crisis. Mortgage delinquency rates are still very low. Roughly where they were in 2019 now. I think they were lower than where they were before the pandemic for the longest time. They just haven't ticked up very much. Homeowners are sitting on record home equity. And we're even seeing that the markets that have seen the biggest slowdown in the West are the markets where people are sitting on record home equity, right? So those are markets where people had seen a huge increase in their home values during the pandemic. They are not desperate to sell whatsoever. And so for buyers that are out there thinking, hey, maybe I should sit this one out and wait, I say this is probably, this is bad. If you're getting that advice on phone, this is really bad advice. Focus on your life. Life continues. And then, I tell people, look, the economy is slowing right now. The one thing I would be worried about more than mortgage rates is income. You would want to make sure that you have enough income to pay those monthly payments when they're due. That's the advice I give people. Don't worry about the mortgage rate because it's impossible for the best of us to predict where mortgage rates are going.
Folks, this is the gospel according to Orphe. Orphe, you're hitting like all the points that I've been thinking about so much. And I am not an irrational housing bull or a housing optimist. I'm a housing rationalist. And the points that you just made about the relationship between inflation, interest rates, and home prices, I feel like I've had this unpopular opinion that the market is actually behaving relatively rationally. And if we see a decline in interest rates, we will likely see a very corresponding increase or upward pressure on home prices in most markets in the US, except for the situation of a severe economic crisis. And the only situation where we see rates come down, and basically the Federal Reserve acting to bring rates down, and home prices coming down, is another scenario not that dissimilar to what we were facing in 2020, where we were looking at a global pandemic and global civil unrest and threats of war. I mean, like, we were not in a good place when rates started coming down in 2020. And I don't think that's an outcome that we can hope for or that I would necessarily bet on.
And look what happened when rates went down in 2020. We had this little bleep in the housing market. And then all of a sudden we had the surge in house prices.
Yep.
Right? It became so cheap to finance a home that people came back strong. I think, I think people are missing the fact that there are so many millennials and Gen Z trying to get on the housing ladder, starting their families, and they're just waiting. They're waiting for the opportunity to come on the market. And to those people, I say, look, if you can afford it, you just have to compare what house prices are today to what your parents or grandparents paid for their homes. Delaying hurts.
Yep.
And so, if you have the opportunity and you can afford it and you are not worried about your income in the future, I think you should be considering getting on the housing ladder. It's still the key to wealth building in this country. Most wealth has been made through housing. And so waiting for mortgage rates, or trying to predict where mortgage rates are going, I hear that a lot. You hear, people on YouTube and all different platforms, pundits talk about the market, and they think that that we're living in a situation that's similar to 08, 09, and it's just not true. You look at the only places where house prices are sliding in the West and Southwest are places that have had where homeowners have seen their home values soar during the pandemic, where homeowners are sitting on record home equity. And it's because prices increased so much in those parts of the country that you saw a huge increase in construction and new building in those markets. A market like Austin, for example, saw massive increase in new construction, which is why they have so much inventory, right? The increase in inventory in that in that region, in that market, is due to the fact that prices were increasing and supply came on. And so that's why. But again, people in Austin are sitting on record home equity. They don't, even though prices are falling there, relative to other parts of the country, sellers are very comfortable.
Absolutely. So, Orphe, I don't want to glaze over your earlier comment on not timing the market. And I think you're uniquely qualified to speak on this topic, given your doctoral work was actually on the behavior of market participants and how that ultimately impacts prices in the stock market. But I think you've already made a parallel to what happens in the housing market. No matter what we say in this podcast, I don't think we're going to convince every consumer in the US not to try to time the market. But how can we help loan originators and real estate agents address that natural desire that first-time home buyers or even move-up buyers feel that they have this unique insight that will help them make a market timing decision that others just can't do?
Yeah, again, people ask me all the time, where are mortgage rates going? And by the way, I get this from very, very smart people. Look, inflation. Just focus on inflation. I think a lot of loan originators and mortgage professionals I talk to them all the time, right? They follow me on LinkedIn, and they follow what the macroeconomic developments. The big picture is the macro, right? And I say inflation is key. If you want to know where mortgage rates are headed, look at the inflation picture. The inflation picture tells us headline inflation has come down somewhat. Disinflation is very much underway, but core inflation remains pretty sticky, right? And the Fed cares about core inflation. It's what dictates kind of their reaction function. And so, because core inflation is somewhat sticky, and it's, I think, roughly 4.6% now year over year, core PCE, compared to the 2% target, right, where they want it to be. The Fed their hands are tied. They almost have to raise interest rates. By the way, we're getting a Fed decision tomorrow, and I think the market expects the Fed to raise interest rates by 25 basis points tomorrow. And so, and another thing that people don't quite understand is they think the Fed is what determines mortgage rates. No, mortgage rates actually are the response of mortgage rates to the Fed decision is very limited. Short-term interest rates are very responsive to the Fed movements. The mortgage rates response is very limited. Mortgage rates are mostly a reflection of current inflation, but also inflation expectations, where investors think inflation is going to be, and the economic outlook. And just for the audience, I think that I'll give you a very good example. If I'm a lender and I expect inflation to be higher next year, right? I'm only going to lend to you if I can get you to pay a rate of interest that's high enough to compensate me for giving you those dollars today, right? I need to be able to buy as much stuff tomorrow when inflation is 5% higher as I would have been able to buy today, right? And so I'm going to raise the interest rate or ask for an interest rate that's high enough to compensate me for the loss of purchasing power that I would incur with the increase in prices over the period of the loan. And so that is why mortgage rates respond by increasing when inflation increases. And by the way, it's not just mortgage rates. It's car loans. It's everything. Every loan, personal loans, interest rates increase across the board when inflation increases. And so if you really want to know, if you're sitting there and thinking, where are mortgage rates going? And say it's impossible to predict, but one clue is in inflation. If you look at if you think inflation is coming down, right, then if you really believe inflation is coming down, then you could say, okay, maybe mortgage rates might tick down because inflation is coming down. And what are we seeing? If you look at the data, we're seeing a number of things. We're seeing, for example, that inflation remains somewhat sticky. We're seeing that the bank turmoil that was widely expected to cause a tightening of lending conditions, to cause a big decrease in economic activity, all right, and slow the economy down. So far, financial conditions, they're tight, but they've actually loosened somewhat in April. And so, they're not quite doing what the Fed was thinking they would have done in April, which would have been a tightening of financial conditions. If you look at, the Chicago Fed has a good financial stress indicator. You see that financial stress has actually decreased and financial conditions have actually loosened in the month of April. And so what that means is that, that financial shock is kind of abating, and it's not quite doing the job of cooling down the economy like the Fed had thought it would right away. And of course, maybe we're going to see that later on, right? It's going to play out. But that combined with core inflation remaining sticky means interest rates have to continue to go up.
This masterclass is brought to you by Zillow Home Loans. Zillow Home Loans is Zillow's affiliated mortgage lender and loan originator. They offer competitive rates and fees, low down payment options, and a variety of loan types to meet the customer's unique mortgage needs. Zillow Home Loans is committed to supporting the homebuyer, alongside their agent to make buying a home a reality. Really interesting. So Orphe, let's move on to our next part of the conversation. And all of our talking points so far have been focused on the dynamics of this quickly and rapidly changing housing market, and affordability is a topic that's come up several times. But focusing in on affordability, I know that you and your team and on the Zillow economic research team have done some work around how affordability is impacting how the market is moving. Can you give us a glimpse into exactly how home price appreciation and the interest rate environment are keeping certain buyers out of the market, and how we might expect that to change as the market continues to evolve or stabilize throughout 2023?
Yeah, look, the typical mortgage payment is up 26% when compared to last year, and affordability is low. And I think we thought at some point that affordability would somewhat stabilize, right? And that you'd see this big improvement in affordability. But this is not quite playing out. And the reason this is not quite playing out is because sellers have kind of are sitting out, right, of this market. Had sellers come back in, we'd see buyers having a lot more options, and we would have seen an increase in bargaining power for buyers and a large improvement in affordability. Mortgage rates have come down somewhat from their high in September, and they've come down somewhat, and so they're down, and so that's a small improvement. But again, they're fluctuating. Like today, they're up, right? So yesterday, I look at Mortgage News Daily, great source for those daily fluctuations in mortgage rate. I look at that, and we were at 6.5%. A week ago, we're at 6.7%, 6.8. We're taking up today. I mean, they're changing so much. Again, to buyers, I say don't focus so much on the mortgage payment and the mortgage rate. If you can afford it today, worry about financing, right? Know what you can afford, get in that house, get on the housing ladder, refinance later. The concern, I think, is a valid concern for a lot of people. The payments are really high, right? To buyers, sometimes what I say to them is a good agent, a really good agent can help you get that home under a monthly payment that is comfortable for you. And there's a lot of things that sellers are doing out there. Sellers are giving away 2-to-1 buy downs, right? A 2-to-1 buy down is basically, the seller getting you at a lower monthly payment for the first 2 years, and then your monthly payment, your rate jumps back up to the typical rate after the first 2 years. Sellers are willing to do some things like that, right? Sellers are willing to get closing costs are another example. You can get a seller to pay part of your closing cost. So having a good agent on your side who's going to help you negotiate through that is going to be helpful for a buyer, especially a first-time home buyer today. Don't focus so much on the price. I think a lot of people are focused on the price. There are creative ways to get to that monthly payment that is comfortable for you. All right. And remember, you could always refinance later. There's also great down payment assistance programs for low-income families and people who have historically struggled to get on the housing ladder, right? So taking advantage of that, at Zillow we have on our website we make mentions of all kinds of programs to help people get on the housing ladder. And again, I cannot stress this enough. Finance first, and then make sure you have a great agent on your side who's going to help you get creative about how to get in that house.
Yeah, it's really interesting. So on the seller incentive side, I imagine that differs pretty widely by market. Markets where there's a certain amount of inventory, or certain other markets where it's really competitive and still multiple offer scenarios. I'm guessing that in the multiple offer scenario markets, the seller concessions or sellers funding a 2-1 buy down are a little less common. Watching the data closely, we've seen a pretty large uptick in incentives coming from home builders, and home builders have been a pretty active part of this cycle. I think we were seeing like 30+% of active listings being new construction right now. Can you give us a little glimpse into how home builders are helping incentivize buyers to purchase this new inventory versus searching for the existing inventory market?
Yeah, look, we were looking at housing starts all of last year, and we thought, oh, that's it. I mean, you look at home builder confidence was plummeting for most of 2022, right? And then, um, and then all of a sudden, at the start of this year, you saw home builder confidence increasing,
We have
right?
4 straight months of confidence
Right.
increases right now.
And I think that took everybody by surprise. Look, home builders are basically telling you, they're telling you where they think demand is going to be in the future. Their job is they have to, right? They have to do a good job at forecasting housing demand because that's how they make money, right? And if they get it wrong, they lose money, right? And so I love paying attention. I pay close attention to home builder confidence because it's very indicative of what builders are facing today, but also what they're thinking about and what they're hopeful or seeing for the future. So you see housing starts plummeting, especially single family housing starts plummeting. And all of a sudden, they kind of flatten out, maybe even a small uptick in Q1 of this year, right? So what is this telling us? Well, it's telling us that builders are very confident about where housing demand is going to be in the near future, right? And I reflect that optimism. I feel optimistic about where the spring of 2024 is going to be, just along with home builders. They have some of their costs with inflation coming down. Some of their costs have gone down, right? Material costs, right? The labor market's also cooling, so wage growth is moderating, so that's also good for builders. You also then have the fact that existing homeowners are not listing their homes. The new listings are down, and they're not coming on the market. Means that basically builders are getting a higher share of sales, higher share of market activity in today's housing market than they probably have ever have in the past. And so all of these factors are working in favor of builders. So builders are actually seeing their bargaining position improve, right? And so today, right now, is probably the best time to get builders to consider helping you with your mortgage payment, right? With buying points for you, right? Taking advantage of the 2-to-1 buy downs. Builders are the ones that were doing a lot of that at the end of last year and even at the start of this year to help. Some builders will pay a lot of your closing costs, right? They don't like to budge on the price too much because very often they have multiple units that they're still building, and they want to make sure the price stays where it's at. But they will give in on closing costs on a 2-to-1 buy down. And so yes, new construction is kind of heating up again, which is a good thing because we need, faced with a housing unit deficit, we need more units to come on the market. We need more new construction. And so I was really pleased to see builders come back to the table in Q1 of this year, and I hope this continues.
Yeah, it seems like there's a long-term demographic tail that builders are paying close attention to. And we have this wave of millennial first-time home buyers that are hitting peak buying age right now. And it seems like Gen Z is coming up behind us millennials, is just as interested in home ownership and potentially even buying at an earlier age than their parents or older siblings purchased at.
Oh, absolutely, and they're making more money, right? The opportunities are unbelievable. Nowadays people just learn skills on the computer.
Yeah.
They learn new skills and they go and get a job. And then you have the work from home phenomenon, right? The idea that you don't have to move to an expensive city anymore. You don't have to go ahead and buy a house in New York or San Francisco necessarily, right? You can work in a more affordable, Midwest town and command a big city salary. So work from home has been tremendous, I think, and is a good thing for this country, for the U.S. economy as a whole. I think historically, because the jobs were concentrated in these expensive cities, that limited the number of talented people who could move there and be matched to these highly productive jobs. Nowadays, you can work from anywhere as long as you have an internet connection. And I think that's great news. And it also means for the housing market that some of these markets, relatively more affordable markets, are going to continue to see a ton more activity than the coastal markets where supply is limited and prices are still very, very high.
Yeah, let's hope the builders keep focusing on some of these cities like you're talking about, the non-coastal markets that are going to be attracting more attention from this new category of educated worker who's not necessarily flooding into New York, LA, or San Francisco. It's definitely an interesting trend to watch as there's a thinking that like the smartest and most talented fled to some of the biggest cities in the country. But we now know that there's some of the most talented and smart people out there, have other lifestyle or family considerations or
That's right.
goals for their own personal financial life that doesn't make some of these expensive coastal markets quite as attractive.
Exactly, and I mean, it's a great job. I mean, you see some of these cities that are growing so fast, and their city centers are growing, and they're more attractive. Bars and restaurants and museums, and it's amazing. I have friends who moved to Franklin, Tennessee. And built a brand new house in Franklin, Tennessee. And Nashville is growing. That metro area is on fire. It's unbelievable. And so there's many places across the country that now you're seeing a lot of people move from the coast in. There's more land to build on, and then you have some of the constraints in some of these big cities in terms of land use regulations. Builders are finding it easier to build in some of these markets in the middle of the country, and so that's good news. That's good news. Hopefully, we can continue to see builders shift their interest to where demand is going, and I'm sure that's exactly what we're going to see.
So Orphe, all of these first-time home buyers and the move-up buyers, everyone who's smart enough not to try to time the market and wait for homes to be on sale by 20%, which I think you and I can agree is an unlikely outcome. All of these people need help with mortgage financing. And at Zillow, you've done some work around the biggest misperceptions that first-time home buyers have around mortgages. Can you share some of those misperceptions, some of the concepts that people don't fully understand, or things have just changed since their parents bought a house?
Look, the first thing is the down payment myth, right? Like everybody thinks you need a 20% down payment, to buy a house, and most people buy their home with what, 8%, 10%. Of course, the lower the amount you put down, the higher your rate is going to be, the higher your monthly payment is going to be. But then you also have to worry about PMI, right? So that mortgage insurance cost. But ultimately, telling first-time home buyers that you don't have to have 20% to get on the housing ladder is really, really important, because the down payment happens to be the biggest barrier to home ownership. The other thing is, if you look at the National Survey of Mortgage Originations, you notice that very few home buyers are confident about how much money they're going to bring. They need to bring down to the table, right? They're not confident about the down payment. They're not confident about closing costs. A lot of first-time home buyers don't even know about closing costs, right? And the closing costs, there's so many of them. There's so many fees that go into closing costs. And so I think it's important and which is why we say finance first. It's important to talk to a mortgage professional, because the mortgage professional will help you understand, the credits that you need, the down payment. We'll discuss the closing costs with you, and then working with an agent to find creative ways to get that home that you're after. So yeah, those are kind of the big myths, especially that 20% down payment myth. It used to be that your parents put down 20%. Nowadays, some people even get away with putting down 5%,
Yep.
and the super wealthy sometimes even go after interest only loans, which is another whole other topic, right? And so I say to buyers, look, talk to that mortgage professional, because that mortgage professional will help you get, and the sooner you start, the better, right? The sooner you start, the better, because they will help you, change your situation a little bit to get you started. The second piece of advice I give to people is, once you're approved, don't change your current situation. No, it's not the time to go changing jobs, right? That's it. You have to stick with it
Don't buy
until
the big pickup truck. Don't get the
don't buy the
boat.
big
Don't
pickup truck. Exactly, exactly, right? Exactly. Don't put a bunch of stuff on your credit cards.
don't
Get
buy
the
your
keys.
furniture before you close.
That's right. That's right. That's right. That's the other thing that I think people miss about mortgage financing. Once it's done, it's done, and make sure you get in that house, get the keys, and then go to Best Buy and buy a new, the fridge and all the stuff, the furniture, whatever, the home movie theater for some people, right? But yeah, that's my advice to buyers. But all of those pitfalls can be avoided by talking to a mortgage professional first.
So this is really interesting because this isn't new information for any of the mortgage or real estate professionals listening to this episode, but it is a reminder that the consumers out there still do not understand what the current down payment and pre-approval and underwriting process looks like. So it's incredibly important that we're proactive in communicating, because if you have a prospective first-time home buyer who is sitting on the sidelines while they wait to save 20%, that's someone who could be active in the 2023 market, who might be waiting around until 24, 25, 26 until they saved a certain amount of money. And if the first time a housing professional on the real estate or mortgage side interacts with them is after they've saved 20%, we could have helped that person get into a house and that they wanted to be in several years earlier, versus having them sit on the sideline waiting for 20% down. Now, that's a bad thing. 20% down is great if you have the resources, but I think we owe it to home buyers and prospective home buyers to make sure they have the information.
And by the way, I think that's great. But by the way, they getting on the ladder is so important, because then you start getting that home equity, right?
100%.
Your home value grows, and the more you delay, the longer it takes for you to move up, right? But also, again, we said at the start of the podcast, home ownership has been so key to wealth building in this country, that there was an interesting stat I saw recently. I think it was put out by the National Association of Realtors, that showed that the wealth gap increase between homeowners and tenants in the last decade was something like 44%. Wealth has increased more for homeowners than renters by something like 44%. I might be misquoting this, but it's crazy. The stat was unbelievable, to think that renters relative to homeowners might have gotten left behind over the past decade. And by the way, most renters are paying that mortgage payment. They're paying. I mean, like, rents.
Many are paying more depend on what it
Exactly.
would cost to own.
Exactly. Exactly. Rents tend to follow house prices. You look at the rental market is finally cooling a little bit, but rents are high. They're the highest they've ever been. Rent growth has cooled, but rents are the highest they've ever been, right? And so I think it's important for us, mortgage professionals, agents, realtors, people in the community, in the industry, to go out and share that information with people, so they don't get left behind.
Orphe, in this conversation, we set out to help inform our audience of housing professionals on how to navigate this rapidly changing market. We've talked about supply and demand. We've talked about interest rates. We talked about not trying to time the market. We talked about affordability and mortgage financing and some of the misperceptions that are out there. Is there anything else that you think we have missed in this first episode of our 4-part series on modern mortgage lending?
No, I think we covered it all. I think to summarize what's going on in the housing market today, affordability is the key, right? Affordability is still front and center. It was front and center during the pandemic. I think it was front and center before the pandemic, and it still is front and center today. I think, mortgage people, housing demand responds to these macro factors. On the demand side, you have income, right, and employment growth. You have interest rates, and you have, you also have non-housing wealth, right? Whether if the stock market is doing really, really well, for example, and incomes are growing, and mortgages are ticking down, people come on the market and buy housing, and that's how it works. And then on the supply side, you have those geographic constraints to building and on the coastal markets, which is why housing is somewhat more expensive on the coast than it is with inside the country. Those areas with mountains, lakes, and oceans, right? Ocean boundaries. And so that's the supply on the supplies. And then you also have man-made constraints to building. And while you can't do much about geographic roadblocks to building, there's a ton we can do at the federal, state, local level to alleviate, to unlock builders, to reform some of our antiquated zoning laws so that builders can actually go ahead and build. You're not going to get, land is getting scarce. Land is a scarce resource. And, you cannot possibly justify the fact that a place like Seattle, for example, where I live, is 75% of Seattle is zoned for single family housing. 75%. That's a crazy statistic. It's unbelievable. It's very similar in places like Washington, D.C., for example, right? And so what does that mean? That means that, with people coming in the region, with people, even just people who have kind of historically been left out of housing, right? People who have in the past not had access because of some of these lending practices of the past that kept some groups out. People who didn't have access to the labor market and are finding jobs, good paying jobs, and getting access in the labor market. People who have had land seized from them because of our history in this country, right? All of those factors are limiting access to housing to those people today, right? The inability to build up or even build out is causing many, many people to be left out. And so at Zillow, we fight to reform zoning across the country. Right? We really believe that we need to improve access to housing for all people. And so I think that's probably a good way to end the podcast by saying, look, zoning reform should be part of the conversation. We need to unlock builders so that we can start to see more housing being built across the country, and so that we can include people who historically have been left out.
100%. You nailed it. And I think as housing professionals, we can all relate with the desire to help people get on the housing ladder, create fair and equitable housing systems, and also create a housing economy that is a great place to do business for all of the mortgage, real estate, home building, and associated businesses out there. So, Orphe, thank you so much for sharing your expertise, your research, your work, your passion. Really enjoyed the conversation, and I can't wait for episode 2 of this 4-part series. Stay tuned.
Thanks for having me.